Welcome back to the Neuro Finance Masterclass. If you've been following our daily explainers, you know we've been building a really solid foundation here. Day 86 was all about corporate shields, and day 87, well, that tackled using leverage against inflation. But today, for day 88, it's time to actually pop the hood. We need to look at the engine of the assets you're buying in the market. So today's theme is the PE ratio, price versus value. We're diving into a concept that literally separates the pros from the rest of the pack. Let's get right into it. There's a core philosophy we really need to internalize today, and it goes like this. The amateur buys the price tag, but the architect buys the cash flow. By the end of this explainer, we're going to completely dismantle those amateur trading habits that might be holding you back and install a true professional mental model.
Exactly, because an architect never buys a stock just because the price chart looks good. No way. They buy the underlying earnings. Keep that firmly in your mind as we go through this.
All right, here's our quick roadmap for today. We'll cover the nominal price illusion, decoding the PE ratio, the coffee shop analogy, the architect's filter, and finally, buying the cash flow. Let's jump into Section 1, the nominal price illusion. This is all about judging a book by its cover. This is absolutely the biggest snare novice investors fall into. They judge a company entirely by its nominal price tag. Someone looks at a $500 stock and literally screams, "Oh, that's way too expensive."
Right. And then they'll see a $2 stock and think, wow, so cheap. I'm going to buy 1,000 shares right now. But here's the thing. The nominal price of a single share means absolutely nothing in a vacuum. Saying a $2 stock is a better deal than a $500 stock without looking under the hood, that's like saying a $2 slice of pizza is a better deal than a $500 brand new car. Without knowing what business you're actually getting a piece of, that dollar amount is completely meaningless.
Moving right along to Section 2, decoding the PE ratio, or FK, fiat by Kazanch. So this brings us to our ultimate weapon for separating a totally meaningless price tag from true value. I'm talking about the PE ratio, or price-to-earnings ratio. Now, in local markets, you'll often see this referred to as F/K, which stands for fiat/Kazanch. It's the absolute alphabet of fundamental analysis. You calculate it simply by taking the current price of a stock and dividing it by the company's earnings per share. This ratio is the vital bridge between what the market is asking you to pay and what the business is actually producing. Let's break down the mechanics of that real quick. You've got two simple components here. First is the price per share, which is just the current market price of one single stock. And then you have the earnings per share, or EPS, which is the company's total net profit divided by its outstanding shares.
In the simplest terms possible, this calculation tells you exactly how much investors are willing to pay for every single dollar of profit the company generates. So, for example, if a stock's P is 20, you're essentially paying $20 to own $1 of that company's current profit.
Okay, Section 3, the coffee shop analogy. Let's bring this to Main Street. Yeah, let's shift from abstract Wall Street theory for a second with a highly effective neurofitness exercise. Just forget the stock market completely. Imagine you want to buy your favorite local coffee shop down the street. The owner's asking price is $100,000.
Right, but before you just write that check, you do the smart thing, right? You ask to see the books. You find out the shop makes a net profit of $10,000 every single year. So you divide the price by the earnings. $100,000 divided by $10,000. That means your payback period, or to use the local term, your amortismisere, is exactly 10 years.
Exactly. And that leaves us with our magic number, 10. The coffee shop has a PE of 10. Think about how powerful that mental model really is. You aren't just staring at a $100,000 asking price and blindly guessing if it's fair. You now know precisely how many years it's going to take for that business to pay for itself based purely on its cash flow. Which takes us to Section 4, the architect's filter. Let's read the market. Now let's zoom back out and apply this exact same logic to the global stock market. You're going to see a massive contrast out there every single day. Take a low PE, let's say between 5 and 8. What does that actually mean? Well, it usually means the asset is undervalued. You're buying a steady, maybe kind of boring business at a massive discount. Or it could mean the market expects the company's profits to shrink in the future. But then on the flip side, you see a high PE, like 30, 50, or even over 100. That is pure market optimism. Investors are perfectly willing to pay a massive premium today because they expect those earnings to absolutely skyrocket tomorrow. We see this all the time with high-tech and AI growth companies. But I have to give you a stern yet helpful warning here. An architect knows that a high PE isn't always bad, and a low PE isn't always a good deal. Say a tech company has a PE of 40, but literally all its competitors trade at 80, well, that 40 might actually be a total steal.
And conversely, if a dying retail store has a PE of 4, it might be cheap for a very good reason, like it's going bankrupt. You always have to compare apples to apples against industry peers and historical averages. Context is absolutely mandatory here.
Finally, Section 5, buying the cash flow, upgrading from amateur to architect. All right, it is time for your graduation. Here's your specific neurofitness cognitive task for today. First, I want you to open up a financial screener, something like TradingView, Yahoo Finance, or Midas/Matrix. Second, search for one giant tech company and check out its PE or F/T ratio. Then search for a traditional energy or banking company and look at that ratio. Just compare them. You're going to see a massive difference in how the market values rapid growth versus tradition. This simple exercise really bridges the gap between theory and real-world wealth building. So, as we wrap up this explainer, I want you to leave with this provocative thought. When you pull up a stock chart tomorrow, ask yourself, are you buying the price tag or are you buying the earnings? From this day forward, I want you to wipe the phrase, "this stock is cheap," from your vocabulary entirely, unless you have rigorously checked its earnings first. Thank you for joining this session of the Neuro Finance Masterclass. Keep building those mental models, stay focused, and we'll see you in the next explainer.